And now I'd like to turn it over to our keynote speaker, Gwen Preston, the resource maven herself, to open the day. Gwen?
Thank you so much, Joanne, and good morning, everyone. Great to be joining you all here today. As you can see, I want to talk about gold and silver, which is not too surprising. They're certainly the topic du jour these days. So why they're running and what you should do about it. I'm just going to jump right in. So bottom line is that gold is a complicated commodity, right? And these are just some of the examples of how and why it's complicated. So gold always has gained with flights to safety, but it's hurt when the other key flight to safety gains, which is the US dollar. Gold thrives on economic uncertainty, but it also gains with inflation, which comes with certainty. So those are counter forces as well. It's often thought that gold moves against the stock market, but not these days. In fact, not for the last sort of decade. So those things make gold confusing. One thing that I want to comment on is that gold's first reaction to major economic events often isn't its inherent reaction, but rather it's a proxy reaction, right? So gold is a tiny market. The US dollar, huge market. Bonds, big market. The stock market, obviously, the huge market within which gold sits. They dominate. And so their reactions happen first and influence gold. Gold's inherent reaction often takes some time and develops second. So when you're looking at gold on a day-to-day basis and you're wondering why its move doesn't seem to make fundamental sense, the reason can often be that gold isn't making its own move yet. It's being pushed around a little bit. Those things certainly matter, but if time is on your side, the day-to-day details of what the gold price is doing, in my opinion, do not matter, because the big picture is that precious metals are going up from here. Why are they going up? Well, by far the most important force that influences the gold price is the real rate of interest. And we are absolutely in a negative real rate environment. This is a chart of the the inflation indexed 10-year treasury, which is a good proxy for real rates. And you can see that for the last best part of a decade, they've been positive. We saw in 2016 that real rates started to fall. And that's when we got the first leg of our gold bull market back in 2016. Seems like a long time ago now. Then they started to rise. Rebounding real rates really hindered the gold market. Then 2019 hit. Real rates started to fall again based on the Fed doing that, dropping interest rates. And so that had given gold some momentum. But then we got this impossible to predict global pandemic, and the Fed slammed interest rates to zero. There is inflation, and therefore real rates are very negative, and they will remain so for years. We've been told that specifically by the Fed, and there is inflation expectation. So negative real rates are the most important driver for gold. When real rates are negative, it does not pay to hold dollar-based holdings. And so all of the money that needs to either just get a yield or have some security, I'll move into that a little bit more in a moment, doesn't get to do the bond game the way that it usually does. Gold, by contrast, sure, it doesn't yield, but it almost always performs when real rates are negative, and therefore it substitutes for bonds. So it becomes the safe haven. Now, this setup is happening. And I think it's really important to remember that this setup is going to be with us for a while. It took the Federal Reserve 7 years to raise interest rates following the Great Financial Crisis. Obviously, COVID-19 is a very different thing, but I think that 7-year time frame is still relevant because it takes a long time for monetary movements to have the desired impact. Now, whether it's going to work, whether, modern monetary theory is the answer, that's a completely separate setup. What I'm talking about, or a different question. What I'm talking about is what is our current setup. We're in a very negative real rate environment, and we're going to be there for some time, especially because Powell specifically has let the inflation target go higher, which encourages even more negative real rates. Then there's that US dollar. That was one of the first comments I made. Gold is hurt by strength in the US dollar. We've been in a US dollar bull market for a long time now. I think there's reason to believe that big structure is over. The reason that gold gained so dramatically in July and August was really because inflation expectations started to rise. And there's valid reason for that. I mean, there's a huge amount of money being printed, and a lot of that money continues to be given directly to people who will spend it. That's very different than the stimulus that happened after the Great Financial Crisis, where most of it went into banks and was not spent. It's spending that causes inflation, and that's what's happening in the COVID-19 monetary and fiscal structure. And so inflation expectations are absolutely rising, and that is, of course, weakness in the US dollar. Then there's there's other big picture influences, like China is in a very long game to reduce its reliance on the US dollar. That game will continue and will continually just erode US dollar strength over a long time frame. There's the ballooning money supply. There's the immense debt loads that a strong dollar makes heavier. And then there's trade wars. The US dollar certainly struggled during the trade war back in 2018, and the trade war has not gone away. It's been pushed to the sidelines by a global pandemic and a presidential election, but it has not gone away. So I think that headwind to gold, there's reason to believe that will be easier in the coming years. And so that just helps the gold thesis. Now, I was talking about, negative real rates matter because they require people to find somewhere else to put their safe money. But the picture is actually bigger than that. So the huge pools of low risk capital that used to own bonds, it's not just the COVID-19 negative real rate environment that means that they can't do that anymore. It's broadly that game doesn't exist anymore. These huge pools of low risk capital used to own bonds. Now, bonds do not pay. And so they have to play the stock market. Now, they've been doing this for a decade, more than a decade already, and it's working fine. The stock market has been doling out lovely, reliable returns. And so this has worked for low risk capital. But low risk capital has to hedge the risks of the stock market. We don't know when the stock market will turn down or what the stock market's going to do. It's clearly doing well, but the risks are real. And so if you want to diversify the risk of exposure to the stock market, you just don't have very many options. I have a chart here of corporate bankruptcies. That's just one example of how the risks are real in the stock market. I'm not predicting a crash, but I'm just saying it's absolutely possible. And then this Twitter quote on the side, I just love. Imagine buying a bond that charges you to own it from an extremely leveraged company. That's the case today. You can't own bonds for yield. It doesn't exist. So that these things combine to mean that if you want to hedge stock exposure, bonds aren't an option. Gold really steps into that gap. Then if we want to look at a few of the specific key things that are happening here today in the world, obviously we are currently in a bit of a sideways suspended animation moment while we wait for November 3rd, right? And so the US election and what's going to happen. We're also in the middle of a global pandemic and there's a trade war. What I think is really interesting is that gold is set up to do well no matter what happens with any of those major occurrences. So whether Biden or Trump gets into office, we will maintain a zero interest rate environment, and then we will get a bunch of stimulus and money printing. If it works, we will get inflation. Even if it doesn't work, we may well get inflation. It all depends how much of it's fiscal, handed out, versus monetary. At the end of the day, the negative real interest rate environment is supported by both candidates. So we kind of just need to get through the election and potentially the lame duck period, and then we will be in a gold supportive environment. So I think it's just really interesting that this huge and difficult to predict event that's so significant also doesn't matter because both candidates will support gold through their actions. COVID, kind of the same. If the case counts continue to rise, then people get anxious. If lockdowns increase, then there's going to be a flight to safety in a zero interest rate environment. That helps gold. If there's a drop in cases, then we probably get growth-based inflation in a zero interest rate environment. That helps gold. So it works either way. Similarly with the trade war, if the trade war escalates, the flight to safety and the Chinese encouraging a gold-backed option for their international trade, those help gold. If it de-escalates, then we get growth and inflation in a zero interest rate environment. That helps gold. So I think this structure is unique. It's really interesting how all of these really important, difficult to predict events work for gold no matter what. Okay, so if everything's so fantastic for gold, why are we currently in this dip, correction, boring phase in the gold market? Well, I mean, Justice Ginsburg died, the stimulus package evaporated, and then those inflation expectations, which had really been rising and pushing gold in July and August, they dipped. And then the market had a fit and gold sold off with everything else. So that precipitated the pause. Then we also just had, the need for a bit of a let's collect our thoughts here after gold had such an incredible run to a record high in July and August. There was a bit of strength in the US dollar that gold had to manage. That was as much to do with weakness in the euro as anything. And then there was portfolio forces. And now we are just waiting for the election. So this dip, this pause, this correction is all very normal. There's reasons that it makes sense. And I think there's reasons to believe that it will end in the coming while, whether with the election or maybe we have to get all the way through to the inauguration. But I think there's good reason to believe that this will end, and it's very normal, and it's not a cause for concern in the gold thesis fundamentally. If you play the junior explorer side of the gold market, there's a few other forces that are impeding the stocks right now. One of them is certainly free trading dates. So a huge number of companies raised money May through August. And that's great. That means lots of companies are out exploring and hopefully making discoveries. And that's fundamentally good for the space. But it also means that all of those shares that were issued in May and June and July had a 4-month hold and are coming free to trade in this time frame. And so for a lot of stocks, they raised money at a certain price. Hopefully the share price gained as they went out to explore and marketed what they were trying to do. And then now the shares that were issued at that lower price are coming free to trade. So that's hurting share prices. So that's certainly, that's a really significant force in the market right now. Slow assay labs are also not helping. They're very overwhelmed. They're slow because of COVID. And so it's taking 3 months instead of 6 weeks to get assay results. So that's also a bit of a problem. And then you can't begrudge mining investors for some profit taking. It's been a tough decade. So when things got hot in July and August, people sold, and so they should. At the end of the day, this bull market is running. What are you going to do to profit? I think the most important comment that I want to make here is that you do not have to be an expert in one part or all parts of the gold, silver mining environment to do well from this bull market. You do have to do 3 things. First of all, you have to understand the forces that impact precious metals and within them determine confidently that we are in a bull market. Okay, I'm there. Maybe you are as well. If you're there, then you have to watch those forces enough to see when that fundamental setup starts to change. I don't think that's going to happen for a few years, but that's part of knowing the macro environment and being comfortable in your outlook. And then you have to know yourself. You have to decide how much time you want to commit to your gold silver portfolio and how much risk you can tolerate. Then you can set up an expectation. Then you can set your expectations appropriately, and you're much more likely to make money and have fun doing it than if you don't go through that process. The great thing about a good gold bull market is whether you're a trader or an investor, whether you're speculating on discoveries or whether you're giving yourself exposure to or leverage to the rising price of gold, it all works. It just has different timelines, different risks, and different needs from you, the investor. The charts that I have here show, GDX is up. This is just an index of major gold miners, and it's up more than 50% year to date. That's not from the bottom of COVID. That's year to date. That's a great gain. Now, Evergold, this is an example I use. It was up 300%, obviously a multiple in terms of the gain, but don't think it's easy to just, I should have bought Evergold and then I would have had 300%. Would you? Would you have sold at the top? Would you have not gotten attached? It's a roller coaster if you're speculating on exploration. And so that's a decision that you have to make. If you do want to speculate on exploration, just remember that exploration is very risky. It feels like there's a flood of discoveries right now. And there are, because way more companies are out exploring than we have seen for a really long time, because the market is back. But don't let that higher number of discoveries let you think that the odds of success on any one target have changed, because they haven't. They actually remain quite low. So the way to manage that risk is to demand from a company, excuse me, that they have more than one strong target or more than one strong project. More kicks at the can gives you a better chance of success. Secondly, you really need to demand strong technical competence from the team and rationale for the targets. They have to be the right team. They have to understand their targets. They can't just be running into an area play or a region or something because they see sort of financial opportunity. They need to know the rocks. They need to have the technical competence. They need to have a really strong reason for doing what they're doing and a plan to test it. Then there's the fact that geology is risk enough in our space. So you want to really make sure that the other risks are limited or managed. So that's things like permitting. That's things like the seasonality of exploration if they're in a high altitude or northern environment. That's things like just getting to the project and being able to operate there. And it's things like, do they have the capital markets and marketing experience and savvy to tell their story? No investor is going to buy a stock that they've never heard of. So demand that your company has those things in hand. If you do like explorers, if you do want to play that game, a few tactics that I think are really important. You need to do some trading. You need to buy in tranches because it's very difficult to pick the bottom. And then you need to pay attention to the whole host of pressures that impact junior share prices. It would be great if it was only about the rocks and what the rocks are doing, but it's not. There's speculation that drives share prices ahead of results. There's free trade dates that really move prices around. There's seasonality. There's price spikes upon discovery that often overshoot the mark. You need to pay attention to these and you need to trade them if you want to be successful speculating on exploration. You should also, if you're in this arena, watch for new deals. There's a lot of really interesting new deals coming to market these days. You should try to participate in financings if that's possible for you, because warrants increase your exposure to a good story. And you need to stay engaged with every story, but don't get too attached. That's a fine balance. So you need to know what they're doing. You need to know what the results mean. You need to know what's coming, but don't get too attached to the people or the project, because trading is key and it's hard to trade if you're too attached. If those things all seem too involved for you, that's fine. They are very involved. It's a lot of work. It's a lot of time. But what's great is just realize that that's not your game and choose a different one. You can absolutely build a buy and hold portfolio that will perform in this market with little risk and won't require much attention at all. And that may well be a better choice. That is a better choice for a lot of people. You can buy Barrick Gold for large leverage to the price of gold. That's what Warren Buffett did. You can buy scale and growth, so slightly smaller operators that have really strong growth profiles. So that's a little bit of extra leverage to a rising price of gold. You can play the royalty scene. Heck, royalty companies have outperformed miners in the bull market, in the bear market, and so far in the bull market. So that's a track record that you can't really deny. They absolutely deserve a place in a low-risk portfolio. You can play optionality. Huge assets are specifically hated in weak markets because they are so expensive to advance and to build. But once the market turns and gets strong, big miners need big projects to stay big in the future. So once the market gets strong enough that miners are ready to start buying, the few big assets that have survived the weak periods get all the attention. That's the optionality play. Those big projects do fine. They, mirror the market, and then suddenly they are the thing that everybody wants. You can try and choose takeout stories, and you can focus on silver. Silver outperforms gold in a bull market almost every time, and silver stocks outperform even more because there are just few of them to choose from. At the end of the day, I think we are set up for a few very exciting years in gold and silver. We're already there right now. It's happening. Corrections are part of the process. If anything, that give you an opportunity to add to positions, to shuffle things around, to reconsider decisions. But it's going to be fun, I think, and it's going to be profitable. But what matters is that you need to build a portfolio that works for you. And that's based on how much focus you want to put into following the news and understanding the stories and the catalysts for a stock, and how much risk you want to commit. Explorers are roller coaster rides. Even when they're super successful, it's still a roller coaster. And like a discovery hit can send a share price soaring, often overshooting the mark. The follow-up holes are as important as those initial holes and are just as difficult. So anyways, exploration is very difficult. You have to trade it. You have to follow the stock. It can be incredibly profitable if you dive in, but you just have to play the game that makes sense for you, for your time, for your knowledge, for your commitment, and for your comfortability with risk. Once you've decided what your plan is, stick to it. And find a few good sources of information to help you do so. And of course, I say that from a little bit of a biased perspective. That's what I do. I write a series of newsletters that are supported by subscribers about what I am buying, selling, and thinking. And I do so to help investors profit from the metals and mining space. If you'd like some more information on that, my website is resourcemaven.ca. And with that, I'd just like to thank the team here for the opportunity to present. And I hope you all have a fantastic day.
Absolutely. Well, Gwen, I appreciate that very much. I know we first met back at PDAC when we had an interview. For anybody who wants to find out more about Gwen, we had a really cool interview. You can go on our YouTube channel. It was there from earlier in the year. But I love hearing all of that because a lot of investors need to hear the fact of the cycles that are going on, how to get exposure, and what different ways of getting that exposure all across gold and various different precious metals and within the resource space. And that's exactly why we're going to be having 6 incredible companies coming up. Sierra Metals being the very first one of the day. That's going to be where we're going to go to right after this. But I just want to be able to come on and just say thank you very much, Gwen, for your time. And I hope everyone enjoyed as well. And like you just said, if you want to find out more information, you've heard where to go as well.